Hey everybody, it's Brooks and Elliott with AgriSompo North America. And while it may not seem like crop insurance season, and in fact, it seems like harvest season to me, there's a product we would like to introduce you to today. Now, Elliott, we've got all kinds of acronyms in the crop insurance business, and we're going to add another one. But MP stands for margin protection, not to be confused with multi-peril, correct?
That is correct. Yeah, we do have a lot of acronyms, but when we say MP, now we're just talking margin protection, not the traditional MPCI. And this is a little bit different product than what we're traditionally used to. So we'll go through some of the details on that today.
Yeah, margin protection is a little bit different in multi-peril, Elliott, in the fact that we look at a set of revenue calculations and expense variables and do a nice job of matching up with current markets, which I think is a pretty important reason why we're having this discussion today.
Yeah, that's correct. I mean, basically, we're trying to do the margin for the county. And I think that's one thing we need to show. So you can see on the screen, this is a product that's going to take the expected county margin, which is derived from establishing expected county revenue, and then subtracting the specific expected county costs. And some of those are fixed and some of those are variable.
You know, those are really good points. I know you like to make sure everybody realizes this is not an individual policy, but something that is county based. I know that's really, really important. When we dig down into margin protection right now, what I like about it is what it protects against in the environment that we're at. And I know there are several different pieces of that. And you can take a look at the slide on the screen and figure out what the three primary components are right now.
Yeah, so obviously, as you identified, county yields. So you have expected county yields, so it is an area-based plan. Your individual farm yields will be ignored in the event of a claim or a non-claim. And sometimes based on the practice, for example, sometimes irrigated practice actually establishes the expected yield on multiple counties or two or more. Commodity prices. So one thing you're going to see with the margin protection product is that we have a much earlier projected price finding time. And then also we have multiple select inputs that RMA has identified as specific for this product.
I think you touched on those 3 points, and what a great time to protect farmers against those things. We had our government report earlier in the week. Prices rocketed up. So that early window may be a benefit this year. Increased price of inputs. Wow, things have gotten crazy here over the last 6 months, and it may be a good time to step in and protect some of those on a county level.
Yeah, it's pretty, the advantage of this product that it goes beyond just yield for the county, price, the difference between projected and harvest. It also now includes those select inputs, such as diesel fuel and fertilizer based on the commodity. So it's really unique in that way. It provides growers another way to protect the expected county margin.
Elliott, let's look at where this is available, because it's not there for everybody, but a lot of folks in the Corn Belt, especially when we're looking at corn and soybeans, are eligible to participate. Those maps do a good job of telling where you can get it, where you can't.
Yeah, obviously the largest geographical areas for corn and soybeans for both margin protection and margin protection with harvest price option. We'll talk about that a little bit. Wheat, that is for spring wheat only, so winter wheat is currently not offered. And then also you can see there is rice. So rice has some select counties in California and then in our southeast.
Standalone policy on its own, or is there any way that you can combine the two?
The nice thing about margin protection and margin protection with the harvest price option, it can be a standalone product. So just based on county yields only, or you can combine it with your underlying base policy, such as a revenue protection policy. Now, some reasons to consider that. Margin protection does not provide you preventive planning nor replant payments. And you may still want some individual coverage. So that's one thing to consider with the combination of them. And just know there's some offsets in the event of a claim, but there's also premium credits to consider.
Of all the components of this program, I really like that we've introduced something with expenses, and that's distinctly different than most MPCI policies out there where we've looked at measuring those expenses. You've got a great calculation up there. And I think back a year ago, and farmers are going to start making decisions on prepays for the positives of protecting expenses out there. If in general, what are some of the parameters that I would want to look at to see if this was a good fit for my farm?
Well, I think the most important thing is, does your operation, do your yields correlate to the county? Not meaning that you have, if the county's a 200 average and you're a 201, it's more that in the peaks and valleys of the historical, are you tracking well with the county? So if you're really concerned about yield, then you have more of a situation where you're going to follow if there's a county-wide situation that impacts that county-derived yield. The other part of that is the prices. If you, depending on how you market or if you have cash sales, because remember, we ignore local cash sales. This is only based on the commodities trade boards. So you have to see how you correlate to those prices. And then of course, now when you're doing the expected county costs, you have to look at those variable input costs. Do you have all those same inputs on your farming operation? And how have you yourself been able to establish a way to protect against that variability during the growing season? And then of course, that's how you're going to get everything triggered. And then the following June after harvest is when the final county yield is going to be calculated, and you're going to be able to determine whether you have an eligible claim under margin protection or not.
So Elliot, we've just touched on the high points, and those were all excellent points. And I know that we could go on all day about the specifics. We are going to have a couple other videos out there where we cover how some of the calculations are made, exactly how everything works. Hopefully we piqued your interest a bit today on margin protection. Follow us for a couple follow-up videos where we'll explain a few more of the details